Welcome to The Deep Dive, your go-to for breaking down earnings calls.
Hello.
Today we're digging into EPR Properties, ticker NYSE. EPR, they're a REIT focused on experiential real estate.
That's right. Think places where people do things. Entertainment, resorts, eat and play venues, not just shopping malls.
Exactly. So our mission today is to, dissect their Q2 2025 performance, their strategic moves, and figure out what it means for them going forward.
Yeah, EPR is navigating a really dynamic market. This call gives us some important clues about their strategy and where they see opportunity. It's about how they're managing assets, capital, and, well, those big trends affecting their tenants.
Okay, let's get straight to the numbers. Q2 2025. GAAP EPS was $0.91. That's a huge jump, 78% year over year.
Pretty substantial.
But for REITs, we look at FFO and AFO, non-GAAP FFOAA, that's funds from operations. As adjusted, came in at $1.26.
Right, a key cash flow metric.
And AFO, adjusted funds from operations, was $1.24, both up about 3.3% year over year.
Solid growth there.
Revenue was $178.1 million, which beat the consensus estimates.
Good top line beat.
And on the capital side, investment spending was $48.6 million, all in that experiential portfolio.
Sticking to their knitting there.
And they also sold off some assets, $35.6 million in dispositions, netting a $16.8 million gain.
In fact, are recycling in action.
And finally, the dividend, important for many investors. It's annualized at $3.54, up 3.5% year over year. And that AFFO payout ratio, a comfortable 71%.
Seems sustainable.
Yeah.
So those numbers, they definitely show some decent operational momentum, right?
Yeah, it looks pretty good on the surface.
But, the market's reaction was, well, a bit more mixed. Shares ticked up a little after hours when the release came out.
Okay.
But then they closed down 2.9% of the day of the actual call, and trading volume spiked noticeably.
So investors were digging in, maybe had some questions.
It suggests they were carefully weighing things.
Yeah.
I mean, despite the revenue beat and the updated guidance, there was a slight miss on adjusted FFO against what analysts expected.
Ah, okay. That might explain it.
Yeah, it seems to signal what you might call a constructively neutral view, like acknowledging the operations are steady, but maybe with a bit of caution, waiting to see how this strategy fully plays out.
Prove it mode, basically.
Something like that. Show us the long-term results of this big portfolio shift.
Okay, let's unpack that shift then. Management talked about continued momentum and disciplined capital allocation. CEO Greg Silvers specifically said they're ahead of expectations on capital recycling. That seems key.
Absolutely. This recycle to upgrade playbook is central.
So what does that actually involve? Selling old stuff, buying new stuff?
Pretty much. But strategically, it means selling assets that aren't core anymore or aren't performing as well, especially some of the legacy theaters, and then plowing that money back into experiential properties they think will give a better return.
Makes sense. How's it working in practice?
Well, Q2 gives some good examples. They sold 3 theater properties for $35.6 million, including a vacant former Regal cinema. Guess who bought it?
Who?
Costco, for $24 million.
Wow, a Costco. That's creative recycling.
Isn't it? It shows they can find buyers even for specialized assets. And then after the quarter ended, they sold their last vacant AMC theater, this one in New Jersey, for about $16 million.
So they're really cleaning house on the theater side.
They are. Over the last 4 years, they've sold 31 theaters, only one vacant one left now. It's all about improving the tenant mix, reducing that theater concentration, and building, embedded NOI growth net operating income.
And this strategy must be shaping where the new money goes too, right?
Yeah, precisely. Management said their cost of capital has improved, so now they're adopting a more aggressive growth posture.
Meaning bigger deals?
Yeah, they mentioned pursuing larger deals, potentially over $100 million. They kept their 2025 investment spending target at $200 to $300 million, so they feel they can ramp things up.
And where are those investments landing? Any new areas?
Definitely seeing new verticals. Their first dip into traditional golf, they bought land for $1.2 million and provided $5.9 million in mortgage financing for a private club down in Georgia.
Golf. Interesting. What else?
They also picked up a second pin stack venue. It's an eat and play concept in Northern Virginia. Bought the land for $1.6 million and are committing $19 million for build-to-suit financing. Expected to open in 2026.
Eat and play seems hot.
It does. And management sounds particularly optimistic about fitness and wellness. They mentioned deep relationships there and growing interest across generations. So diversifying beyond just movies.
Speaking of movies, though, The box office recovery has got to be important for the remaining theaters. How's that looking?
It's definitely a factor. The North American box office is showing sustained momentum. Q2 2025 hit $2.7 billion.
Wow.
Yeah, up a huge 37% from Q2 last year. And the first half of 2025 overall was $4.1 billion, up 15% from the first half of 2024.
So the recovery is real.
It seems so. EPR is sticking to their estimate for the full year 2025, somewhere between $9.3 and $9.7 billion.
And that flows through to their rent.
Directly impacts it, especially percentage rents, where rent is tied partly to how well the theater does.
Right.
The big Regal master lease, for example, is expected to generate a significant increase in percentage rent compared to 2024, thanks to the box office bounce back and an improved lease structure they negotiated.
And more movies coming out helps too, I assume.
Absolutely. They're encouraged by more films being developed and new players like Apple and Amazon getting into theatrical releases. That content pipeline is key.
Okay, so they're recycling assets, investing in new areas, getting a boost from the box office. But they need the financial foundation for all this. How's the balance sheet?
Management described it as being in great shape, which is what you want to hear during a transformation.
Definitely.
They paid off $300 million in notes back in April using their credit line. And crucially, no other debt maturities are coming up in the next 12 months.
That gives them breathing room.
It does. Liquidity looks strong, about $13 million in cash, plus they've only drawn $405 million on their $1 billion revolver. Lots of capacity left.
And their debt levels.
Net debt to adjusted EBITDA. That key REIT metric is at the low end of their target range. Yeah. So they're managing leverage well.
Any plans to issue stock?
Not assumed in the 2025 guidance. But they are setting up an at-the-market program, an ATM.
So they can sell shares gradually if needed.
Exactly. It gives them flexibility to raise capital, maybe for larger deals or through forward transactions, without doing a big disruptive offering, just keeping their options open.
Sounds like they're well-positioned financially. Okay, before we get to the bigger picture, what about guidance for the rest of 2025? Any changes there?
They reaffirm the key numbers. FFOAA guidance is still $5 to $5.16 per share. That's a nice 4.3% increase at the midpoint over last year.
Okay.
Investment spending guidance also held steady at $200 million to $300 million. Still confident in their pipeline.
But didn't you say they were ahead on recycling? Did that change anything?
Good catch, yes. Disposition guidance, how much they plan to sell, was actually raised.
Raised by how much?
Up to $130 million to $145 million. Previously, it was $80 million to $120 million.
That's a pretty big jump.
It really underscores how committed they are to that recycle to upgrade strategy. They're leaning into it.
Okay, shifting to the bigger picture now. What are the key takeaways for investors listening to this call? Anything beyond the numbers?
Well, one significant thing is an upcoming leadership transition on the investment side.
Oh, who's changing?
Greg Zimmerman, the current EVP and Chief Investment Officer, plans to retire in early 2026.
That's a key role.
It is, but they've got a succession plan lined up. Ben Fox is joining this August as an EVP, and he'll take over as CIO when Zimmerman retires.
Does he have relevant experience?
Very much so. He comes with substantial experience in the net lease REIT world. The company called it a quiet positive for their deal flow and structuring skills.
So continuity plus maybe some fresh expertise.
That seems to be the idea. Leveraging that net lease background potentially opens up new angles for deals.
And how competitive is it out there when they're trying to make these deals, especially the larger ones they're targeting now?
It kind of depends on the deal size. For smaller stuff, say $50 million or less, there's more competition. Other REITs, family offices, you know the drill.
Right.
But for the bigger deals, over $100 million, the field changes. Private equity isn't as interested because their investment timelines are often shorter.
Okay, so who is competing then?
Credit funds become more prominent players there. But interestingly, EPR often gets inbound calls from sellers for these larger opportunities.
Really? People come to them?
Yeah, their brand recognition and specialized expertise in experiential real estate give them an edge. It's a nice position to be in.
That makes sense. Okay, what about the wider economy? Management mentioned ongoing cross-currents. How are those impacting the demand for experiences? Are people still spending?
That's always the big question, isn't it? Management emphasized that consumer spending on experiences remains resilient, despite those macroeconomic headwinds.
Any specific examples?
Well, they said eat and play venues are doing really well, performing above pre-COVID levels even. That suggests a strong desire for social activities.
Okay, that's positive.
Some other attractions had a mixed start to the season, maybe due to weather, but things like hot springs resorts, they're apparently booming. 3 of EPR's properties actually made a USA Today top 10 list.
Huh. Hot Springs. Didn't see that coming.
Me neither, but it fits the wellness trend. They also mentioned lower gas prices being generally helpful for consumers' discretionary budgets, even if it doesn't directly track visits to one specific property.
Right.
And of course, the box office recovery is a big plus. But, those negative theater headlines still linger in the background for investors. Even while EPR is actively trimming that exposure, it's a balancing act.
So pulling it all together for investors listening, what are the key catalysts they should watch for, things that could drive the stock?
Okay, catalysts. Definitely watch their quarterly updates on dispositions. Are they hitting that higher target? That execution is key.
Right.
Also, keep an eye on leasing trends and how those percentage rents perform alongside the box office. Any big movie hits could provide a nice bump.
Makes sense. Anything else?
Yeah, any news on them using that ATM program for accretive investments would be notable. And guidance updates tied to new projects coming online. The big opportunity. If the box office stays stable and they successfully recycle capital into these diversified experiential assets, you could see the market start to value their FFO, their cash flow, more highly what they call an FFO durability re-rating.
And the risks. What should investors worry about?
The main risks are probably twofold. One, a broader slowdown in consumer spending that hits their various experiential properties.
Okay.
And two, any major new setbacks in the theater industry that their diversification doesn't fully offset. Either of those could put pressure on the stock's valuation, limit that multiple expansion.
Okay. Now for our slightly different segment, the one we call This Is Not Financial Advice.
Oh, the fun part.
Imagine we're pitching a wild, but maybe plausible trade idea based purely on what we heard in this earnings call. What's your outrageous but plausible pitch today?
All right, let's run with this strategic transformation theme. Given EPR's really aggressive recycle to upgrade plan, selling off theaters, buying into wellness and golf,
Oh.
how about a long-short paired trade?
Ooh, okay. A pair trade. I like it. What's the long?
Do long EPR properties, NYSE, EPR. Simple logic.
Right.
They're actively ditching lower growth, higher risk legacy assets.
Right.
And buying into higher return, more resilient experiential stuff. Their better cost of capital lets them do bigger deals, and the new CIO brings that net lease expertise. Plus, the box office recovery helps the theaters they still own while they diversify. It's basically a bet on this strategic pivot working, and the market recognizing the improved quality of their portfolio over time.
Okay, long EPR based on successful transformation. Makes sense. What's the short side?
For the short leg, you target a traditional undiversified retail REIT.
Like a classic mall owner.
Exactly. Think pure play malls, maybe heavily exposed to struggling department stores, lots of traditional inline shops, not much experiential stuff happening.
Okay, why short them?
The thesis is simple contrast. While EPR adapts, this traditional REIT keeps facing headwinds from e-commerce. Cautious consumers, maybe they're slower to recycle assets or diversify. You're betting that the gap between the growth prospects of EPR's forward-looking experiential portfolio and this legacy retail portfolio will widen.
So you expect EPR to outperform?
Significantly over time. The market, we bet, will increasingly reward EPR's agility and focus on where consumers are going, compared to a REIT stuck with yesterday's retail model. You're capitalizing on that divergence driven by shifting consumer behavior. It's a bet on the future versus the past of real estate.
And that wraps up our deep dive into EPR Properties Q2 2025 earnings call. A company clearly in motion, transforming its portfolio, trying to ride that experiential wave, and doing it with a solid balance sheet and new leadership on the way.
Indeed. That recycle to upgrade strategy is front and center. Combined with the box office tailwind and their push into new areas like wellness and golf, it really positions them for, continued evolution.
Though the market's initial reaction shows execution is still key, right?
Absolutely. They need to keep delivering on that strategy. It's a really fascinating case study in how real estate adapts.
Well, we hope this discussion on EPR properties gave you some useful insights. As always, remember, this is for informational purposes only. It's not financial advice. Please do your own research.
What's really interesting is seeing companies like EPR not just react, but try to anticipate and shape where real estate is going based on consumer behavior. Which makes you wonder, and this is a question for you listening, what other real estate sectors do you see going through similar transformations right now? And which companies look best positioned to really capitalize on those shifts?
Something to think about. Until next time, stay informed and keep learning.